Welcome back to Intelligent Investment Today. This is a podcast where we explore the timeless principles of value investing. The ideas that help investors navigate markets, not just in times of prosperity, but also in moments of uncertainty and crisis. Many of those ideas were laid down by the man widely regarded as the founding father of value investing, the tutor and mentor to Warren Buffett no less. We are, of course, once again talking about the late, great Benjamin Graham. Now, in today's episode, we're going to be applying Graham's behavioural lessons to a situation investors are confronting right now: the rising geopolitical tension in the Middle East involving Iran, and the uncertainty that comes with it. Moments like this are uncomfortable for investors. Markets become volatile, energy prices surge, and excitable headlines multiply by the hour. And suddenly, the calm, rational framework we use to analyse investments is surrounded by noise, speculation, and emotion. It's precisely the kind of environment that Graham's teachings were designed to navigate. Because while the specifics of crises change, whether they involve wars, recessions, financial panics, or geopolitical tensions, the psychology of investors tends to remain remarkably consistent. Fear spreads quickly, markets react rapidly, and disciplined investors are forced to confront a difficult question. How do you remain rational when the market around you becomes emotional? So in this episode, we'll explore how Graham's behavioural principles can help investors remain disciplined during periods of geopolitical uncertainty, including the current tensions involving Iran. We'll look at why markets often overreact to crises, how volatility can create opportunity for the patient investor, and why emotional discipline remains one of the most valuable skills an investor can develop. So, as always, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. Geopolitical crises have always had a powerful influence on financial markets. When uncertainty rises, investors tend to move quickly to reduce perceived risk. Stock markets fall, energy prices rise, safe haven assets attract demand. The current tensions in the Middle East are a perfect example. Iran sits at the centre of one of the world's most strategically important energy regions. The Strait of Hormuz, through which a significant proportion of global oil supply flows, lies directly alongside Iranian territory. Even the possibility of disruption to this route can push oil prices sharply higher and inject volatility into global markets. But here's the important point Graham would emphasise. Markets react quickly, often faster than rational analysis can keep up. Investors respond to headlines before they fully understand the long-term implications. And when that happens, price movements can become driven more by emotion than fundamentals. And this brings us directly to one of Graham's most famous ideas, one that will be very familiar to regular listeners of this podcast. Benjamin Graham asked investors to imagine the stock market as a business partner called Mr. Market. Each day, Mr. Market offers to buy your shares or sell you his at a particular price. But Mr. Market is not always rational. Some days he's optimistic and offers a very high price. Other days he's pessimistic and offers very low ones. And crucially, you're under no obligation to do business with him. And geopolitical crises often push Mr. Market into one of his most emotional states. Fear spreads quickly, prices swing sharply, and investors begin reacting to narratives rather than analysing businesses. Graham's advice was simple but powerful. Use the market as a servant and not as a guide. When markets panic, intelligent investors step back and ask a very different question. Not what is the market doing, but rather, what are these businesses actually worth? Another behavioural mistake investors often make during crises is to confuse volatility with risk. When markets fall quickly, the instinctive response is to assume something fundamental has changed. But Graham emphasised that risk should be measured not by price fluctuations, but by the potential for permanent loss of capital. Volatility, in contrast, is simply the market reacting to uncertainty. Take the current situation. If oil prices surge due to geopolitical tensions, some industries may indeed face temporary pressure. Airlines, transportation companies, and energy-intensive sectors. But many businesses will continue operating largely as before. The long-term earning power may remain intact, and yet their share prices may still fall, simply because investors are reducing exposure to risk more broadly. For disciplined investors, this distinction is critical, because volatility can sometimes create opportunities to purchase high-quality businesses at temporarily depressed prices. Investors don't always carefully differentiate between companies. Instead, entire sectors or markets may decline together. And this is where Graham's concept of intrinsic value becomes particularly useful. If a company's long-term earnings power and financial strength remain intact, then a falling share price may actually represent an improving opportunity. History provides many examples of this dynamic. Markets fell during the Gulf War. They fell during the Iraq War. They fell during the 2008 financial crisis. And again during the early days of the COVID pandemic. In each case, the initial market reaction was driven largely by uncertainty and fear. But over time, the market's weighing machine, as Graham famously described it, began to reassert itself. Businesses with strong fundamentals eventually saw their value recognised. While short-term market movements are notoriously unpredictable, the long-term value of productive businesses eventually begin to reveal themselves. Geopolitical crises feel urgent in the moment. The headlines suggest dramatic change. But history shows that markets are remarkably resilient over long periods. Wars end, economies adapt, supply chains adjust, and businesses continue generating profits. For investors with a long-term perspective, this resilience becomes a powerful advantage. Because while short-term traders react to headlines, long-term investors can focus on underlying economic value. One of Benjamin Graham's other famous concepts is the margin of safety. The margin of safety refers to purchasing an investment at a price significantly below its intrinsic value. That difference acts as a cushion against uncertainty, errors in judgment, and unforeseen future events. And geopolitical crises are exactly the type of events the margin of safety is designed to protect against. When investors buy businesses at large discounts to their intrinsic value, temporary disruptions are far less likely to result in permanent loss. In other words, the margin of safety provides not just financial protection, but psychological protection as well. It allows investors to remain patient when markets become volatile. Ultimately, crises like the current tensions in the Middle East represent more than just geopolitical events. For investors, they are behavioural tests. Tests of patience, tests of discipline, and tests of whether we truly follow the principles we claim to believe in. Anyone can remain calm when markets are rising. It's dead easy. But true investment discipline is revealed only during periods of uncertainty. Benjamin Graham understood this better than almost anyone. Having lived through the Great Depression, he knew that markets would always experience fear, volatility, and emotional swings. But he also knew that investors who remained rational and focused on intrinsic value would ultimately find opportunities. And on that note, we shall draw this edition of Intelligent Investment Today to a close. I hope you've enjoyed it, and that these reflections on Benjamin Graham's behavioural lessons have reinforced another important truth: that intelligent investing isn't about predicting every geopolitical event or market movement. Rather, it's about maintaining discipline, focusing on intrinsic value, and remaining patient when uncertainty inevitably arises. If you found the episode worthwhile, and you haven't done so already, do consider subscribing or adding to your playlist, so you'll be reminded whenever a new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.